What a day to be speaking to you. Was this inevitable given the decline, the plunge in the yen?
Look, I mean, the Bank of Japan saw and the Ministry of Finance saw some speculative activity. We know about the fundamentals. You've got long-term investors continuing to pick up interests rising in the United States, borrowing low here. But over the last week, there was some speculative activity, and that's what the MOF wanted to squash today.
Will it, though? I mean, how long can this last for, the support brought by intervention, when you still have the widening rate differentials?
Look, it's two fundamental forces that got us from 115 to 140, 145. And that's number one, as you point out, the widening interest rate differential. And then you also have Japan running a trade and current account deficit. So it's actually the two fundamental forces pointing towards a weaker yen. So from that perspective, the Bank of Japan and the Ministry of Finance is just actually fueling liquidity in the market. And yes, as a speculator, I am bleeding today, but I'm going to take back on those positions. And I personally think that 155, 160 is still on the card.
Yes, but I just want to throw up this chart, which, we painstakingly combed through that data to present to you, which is basically Ministry of Finance data showing what we see as the intervention to counter yen weakness, and historically what we've seen, intervention to counter yen strength. There in the green is the intervention to counter yen weakness. What else can they do? Would this have been more impactful had it been coordinated with the United States?
Look, I mean, you remember, back the last time when the yen was at 140, 147, it was actually then Treasury Secretary Bob Rubin who stood in front of the media and said a strong dollar is no longer in the interest of America. That, really sent a shock to the market and prevented, the yen from weakening further. The question really you've got to ask yourself, is a strong dollar in America's interest, or is it not? Certainly it is, in the sense that it reduces inflationary pressures in the United States because it lowers import prices. But at the same time, a strong dollar does reduce profits of American corporations, because about 45% of profits from S&P 500 companies come from overseas. So when the dollar gets stronger, those revenues, those profits translate into fewer dollars. Right now, I think a strong dollar still is in America's interest. So I think, the Ministry of Finance sends a signal, but at the end of the day, it's not going to prevent the trend.
It also comes at a time when we see national interest diverging. It's every nation for itself, it seems, and the kind of disintegration of the global economy as well. Are the currency market problems reminiscent of what we saw in the 80s? And is it possible to culminate in something like the Plaza Accord?
Heidi, it's very interesting you say that. I would make exactly the opposite argument. We've got flexible exchange rate so that countries can actually run divergent monetary and fiscal policy. That's the whole point of having a flexible exchange rate system. And when you look at Japan, I am sorry to say, we do not have demand. We've got an output gap that is still running at about 2 to 3%. You find the overall economy, you find consumption expenditure, even business investment expenditure still below the pre-COVID trend, no wage growth. So from that perspective, Governor Kuroda is 100% correct. The economy is still weak. It is not America. And as a result of that, both fiscal and monetary policy needs to continue to support. And if the yen weakens, so be it.